against the initial apprehensions about delays in execution, Reach Shipbuilders and Engineers has crossed all historical levels in terms of growth. In FY22, the company delivered strong 54% growth in revenue. Moreover, the momentum continued in the June quarter as well, with revenue growing at 91% on a year-on-year basis to 580 crores. While part of this could be attributed to easing execution challenges, which were caused by COVID-led issues last year, a large amount of this is due to strong focus on faster execution of the orders in hand. As a result of higher deliveries, revenue is much ahead of the pre-COVID levels. Grse, which generates close to 98% of its revenue from the shipbuilding segment, has increased its focus on execution. Orders which were delayed or had suffered a lag because of COVID-led supply and logistics issues were waiting to be booked in the revenue, and this has led to a sudden spike in the top line. Moreover, because of higher scale, operating margins and profitability have improved significantly, allowing the company to partly offset the impact of increased input prices. During the June quarter, the company's cost of materials consumed jumped by 133% year-on-year. While the company can pass through the cost, a part of this or sudden spike in material prices like steel and energy impacts profitability. Now, this is also a reason that despite the higher scale, EBITDA margins dropped marginally by 22 basis points on a quarter-on-quarter basis. I'm using quarter-on-quarter as reference because last year's margins are not comparable because of small scale and impact of COVID-19. But thanks to strong execution, increase in input cost was absorbed largely and profitability was much better than expectations. And this is also reflected in its net profits for the quarter, which shot up by 144% on a year-on-year basis. Growth momentum is expected to continue in the coming quarters. The company is currently working on 7 projects comprising 15 ships for the Navy, Coast Guard, surveillance and others. Despite strong execution, the company continues to hold a strong order book of close to 23,580 crores, which is 13 times its FY22 revenue. In the June quarter, the company launched 4 new ships and expects the deliveries and execution to be better over the next 2-3 years because of the large value projects which are currently under execution. That apart, with easing metal and energy prices, margin should be better supporting higher earnings in the coming quarters. Notably, the company is sitting on cash and cash equivalent of close to 2,500 crores, and with increasing interest rates, there should be higher treasury income supporting earnings further. Meanwhile, Grse's share prices have corrected recently, led by overall weakness in the stock market, especially in mid-caps. The stock has fallen from the high of 324 per share in May 22 to current price of around 259 rupees a piece. Interestingly, with close to a 3% dividend yield, valuations are quite attractive at 9 times its FY24 estimated earnings. Overall, strong order book, growth opportunities, sustainability of the business, cash in the books, improving execution and margins, along with attractive valuations should reward investors in the long run.